It might surprise you to learn that as serious as stock investing is, you expect individuals to make decisions that are governed by reasons, logic, but unfortunately, most of the times, decisions are made in the market based on sentiments. At least short-term decisions are made based on sentiments. And so in this video, I want to talk about 10 critical factors driving investor sentiments and market trends. What are the factors that drives, that directs, that influences investor sentiments, and that tend to control or influence or impact market trends. Market sentiments refers to the overall attitude or mood of investors towards a particular market or assets at a given time. It plays a significant role in influencing stock market performance as it impacts trading decisions as well as on stock prices. That's it's really interesting. Just sentiments, psychology, feelings, instead of hardcore facts or company fundamentals. And so here is a breakdown of how market sentiments and stock market performance are interconnected. Discover that market performance are, by and large affected by, uh, by sentiments displayed by participants in the market. Number one is economic indicators. Indicators, such as GDP growth, unemployment rates, inflation, and consumer confidence strongly, shape investors' outlook. Positive indicators can boost sentiments, while negative data can dampen sentiments. So all in all, it all boils down to sentiments. When people are euphoric and pessimistic and optimistic, it affects stock prices. When they are pessimistic and discouraged, then it equally affects, how they invest, and invariably, it influences stock prices as well. Number two is corporate earning reports. Strong earnings and upbeat guidance from major companies often create positive sentiments, while disappointing results can lead to pessimism. And so, behavior like pessimism, like optimism, will go a long way, in influencing stock prices. Number three is global events. Geopolitical tensions, trade agreements, pandemic, or natural disasters can significantly impact sentiment by creating uncertainty or optimism. So it all boils down to how these events affect human behavior. The events themselves, may not really matter, but it's how human beings react to these events that will eventually influence how they invest in the market, whether to become net buyers or net sellers in the market. And all these activities actually, determines overall movement of prices in the market. Please subscribe to this channel and like this video if you've not done that. Number four is central bank policies. Central bank policies. Most countries have central banks, and their policies, tends to affect consumer, investor behavior. So changes in interest rates or monetary policies, such as quantitative easing or tightening, directly influence investor confidence and market trend. We all heard about QE, QE1, QE2, all those intervention by the government certainly affects the stock market one way or the other, depending on the nature of the intervention, the nature of the policy. Number five is market trends. Prolonged bull or bear markets can reinforce bullish or bearish sentiments as investors follow momentum. In a typical bear market, stocks will tend to go higher and higher. And in a typical in a typical bull market, stocks will tend to go higher and higher. In a typical bear market, stocks will equally respond. They will go lower and lower. So once they take a particular upwards or downward trends, they tend to maintain those trends for a considerable length of time. Number 6 is media and news. News outlets and social media play a significant role in shaping perceptions. They shape our perceptions a lot, actually, as we feed it with our our phones, our smartphones, and we are bombarded with information we cannot adequately filter. We discover that knowingly or unknowingly we respond to those news, and that will equally uh, influence the way we invest. And so positive headlines can spur optimism, while negative ones will create panic. And once panic is created, people will start people will go into panic mode, and you start selling even good companies at that point in time. So we should learn to be disciplined and avoid panic, market panic. Number number 7 is investor behavior. This has to do with psychological biases such as herd mentality, overreaction to news, as well as amplifying prevailing market sentiments. Whenever there's optimism, people tend to amplify it. Whenever there's pessimism, they equally tend to amplify it. And so human behavior is a critical factor on how stock markets behaves, on how stock prices, fluctuates. It determines volatility in actual sense. Number 8 is volatility levels. Volatility levels. So high market volatility, often measured by volatility index, typically indicates fear or uncertainty, fear or greed. While low volatility suggests stability. In a stable stock market, discover that the level of volatility as measured by the index is relatively low compared to when the market is kind of euphoric. Number 9 is sector-specific trends. Some trends are kind of related to specific sectors. Changes in specific industries, such as tech innovation or energy price shift, can influence sentiments for related stocks or the broader market. In a case, let's take for instance, the oil price in international markets can affect sentiments in that particular sector. People who invest in those sectors will behave in accordance to whatever is happening to oil prices, to crude oil prices in the international markets. Number 10 is government policies and regulations. Actually, the stock market is not an island. It's not a lawless community. It's regulated by the government. And these regulations actually, tends to affect the market one way or the other. So fiscal policies, tax reforms, or regulatory changes directly affect industries or markets. And that can sway investor confidence. And so by monitoring these factors, investors can gauge market sentiments and align their strategies accordingly. And so even when you are serious-minded fundamental investors, you still need to pay attention to sentiment, because in the short run, markets tend to be directed, influenced, impacted by sentiment displayed by participants in the market. And so it's necessary, at least in the short run. That is what tends to influence the market. So do you base your decisions on core company fundamentals? Please don't forget the impact of sentiments on stock prices. It's necessary you consider these aspects.